number 3. This one is going to be a little bit different than the first 2 because I have been pretty much following along the sequence of what was in that book, Trend Analysis, that I wrote. When I wrote that, it was well and good, and it had a flow to it, and there was a little feature in there where I was on this fantasy trip through the knowledge and through life and so forth. We're not featuring that, shall we say, on this video series. So this lesson today is going to be a little more taken from the 10 Commandments story. Moses had been up on a mountain for approximately 40 days, and he was coming down the mountain. And in that process of Moses being up there, he literally had been pumped full of sunshine, and he was glowing in the dark, literally, the Bible says. So I promised you were not going to glow in the dark. I wasn't going to do anything like that to you. But Moses came down, and while he was up on the mountain, he had been in a very spiritual, theological sort of mindset, shall we say. When he came down the mountain, he found everybody doing bad stuff. And Moses got very excited, negative fashion, and he threw down these 3 tablets that he had. The first one, which was, I take it, first, second, third, was the one that hit, I assume, the first, and it took the impact, and it broke. The other 2 above it, today, I think it's called the Decalogue, or as we call them, 10 Commandments, people in churches, laymen. And so those 10 Commandments over the years have been, PhDs have been earned, theology, sociology, philosophy, ad infinitum. And they have been unpacked to the max. So today, what I'm going to do is give the handout here to the class, and it is going to be pretty much the big high points of what we're going to unpack for the next couple of weeks. This is the keys to the kingdom of how easy and how simple it is to do this financial stuff. And the only reason that we're not doing it is nobody is teaching this anywhere. When I first started, I paid some very hard, serious cash to learn stuff. And one of the better things that I learned was I had an account with TD Ameritrade. And fine company, they do a great job. They have an absolutely outstanding way of approaching fundamental analysis. Best I've ever found yet. And I recommend that to anybody and everybody. There's a kind of a catch, though, for TD Ameritrade in that they want you to have funds deposited with them before you will get access to all of these good things. So I have tried to give everybody pretty much the basics. So search engines are Google and Yahoo today. Google is good. I'm not going to knock them. There's one feature in Google, however, for their finance section that I don't particularly get too excited about. I'm not going to say it's wrong. It's just that not my cup of tea. They want to know who you are. And with that, they can then track what you are doing. And Yahoo, they don't care. Anybody and everybody can go, and they will just gladly give you the same information. So, since I don't want people knowing particularly what I'm doing, I fly under everybody's radar, remember? I go to Yahoo. Now, this is the homepage that comes up on the Yahoo website. And it's pretty much standard format. There'll be a big picture, some stuff that they want you to look at, you know, the secondary. Then it starts in. There's always a search bar at the top. And then down the side here, they have these various major areas. Nobody ever goes through these. If you want to be highly obsessive compulsive and ADD, you can go through each one of these and you will spend days, particularly in the finance section, because there is such a huge mountain of stuff that is buried in that little tab. So, Yahoo. The next major thing that I recommend is fundamental analysis. This is absolutely crucial for anybody that is doing finance. You have to know, back up. Fundamental analysis is the way that a person finds out if this company that you're looking at is a good company or not. A good ETF, that's exchange traded fund, and I'll talk more about that in a minute. But these stocks, ETFs, they're traded, and you can have ownership of them. They're not a time-sensitive item like an option. Option, you have so many days to exercise that option or it expires. With ownership, you got it forever. And you can watch it go up and down and up and down. And over the course of 15 years, I guarantee you, it'll go nowhere. So, fundamental analysis, that is something that everybody needs to seriously think about. Is the company a good company? Hand in hand with that is technical analysis. And with this information here, that tells you, is this the right time to buy or to sell? And there was a situation that happened, I think it was around 2003, 4, if I remember right. A company called Enron was selling and buying power futures, I think it was, for the electrical grid across the country here. And everybody was just so excited. Enron was the hot commodity future. And then all of a sudden, they were just, a scandal to the nth degree. They went bankrupt. I think it was either the president or the vice president. He had a heart attack and died. Other people went to jail. And people that thought they were set for life, they were walking out of the offices with all of their treasures and personal effects in a box, and they were not happy. So between fundamental analysis, is the company a good company, and technical analysis, should I buy or sell now, the timing issues, somebody dropped the ball. And I am of the opinion that everybody was looking at the price charts, the technical stuff, and nobody was looking at the fundamental stuff. If they would have been, the earnings to price ratio, things like that, would have been so far out of the ballpark that everybody would have said, whoops, and called a halt to it. What did happen exactly. At that time, I was not into finance at all. And all I knew was that on the West Coast, we were having brownouts because the power just wasn't there anymore. So there's that. The next major item that I'm going to unpack off the trailer today is the topic of stock screeners. And that's exactly what it means. You screen for a stock that you want. You get to set the parameters of whether it's going to be between a certain price range, whether or not it's what's known as small cap, mid cap, big company, whatever. You set the parameters, regional, whatever. The best company I know is called FinViz. That means financialvisualization.com. And FinViz takes all this data and mashes it up and puts it in a graphic format. Squares, circles, whatever, you get to define it again. It is so awesome because before the PC, people would spend weeks sifting through page after page, very thin paper, looking for something that lit their fancy up. Today, you punch a button, boom, you've got it. You can have all stocks that are rising. If you're a more advanced student and you understand what it means to short a stock, I'll explain that again in lesson 3 or 4 lessons from now. You can make money, very good money doing that. You can also use your screener to find all the stocks that are going downhill, going down. Okay, next major bundle is exchange traded funds, ETFs. And this is where we have a humongous mashup of all the companies that are in the similar field. The cover of the book that I did, Trend Analysis, all I wanted at that point, I didn't know what to do. All I wanted was a nice, pretty picture that I could put on the front of the book that would help to exemplify what I was looking at. And so I just, out of the thin air, decided I was going to look at airplane stocks, commercial airlines. And I went to an ETF for commercial airlines, and I opened it up to look inside that ETF to see what stocks were in there. And one of the things that popped up was this one particular company. And I looked at their price chart and I thought, this doesn't excite me at all. And so then, but it was the little seed that had been planted already. So I started looking around to see why this company that was not impressive to me was number one in the ETF. I figured somebody knew something that I didn't. And so I started looking at the financial blogs. If you go on your search engine and you put financial blogs, oh, you'll get bombed big time. You'll have people from Bangladesh, from India, you name it, Russia even, that are commenting on whatever. And it could be everything from soup to nuts. But I kept looking and looking. And again, you have to be somewhat obsessive, compulsive to wade through all of the extraneous stuff. That means fancy words for some undesirable things, stuff. Anyway, I finally found people that were very excited about some orders and some stuff that was down the road. I didn't see it on the price chart. This was not exactly, okay, back up. Price charts are current and past information. Plans and expectations, they're never on a price chart. And the blogs, they talk about those. So when I was looking at the price chart, I wasn't seeing anything. When I looked at the blogs, it was like, oh yeah, everybody's excited. So I thought, I'm gonna watch this and see what happens. And if you open up that book and look at the back page, start at the left side, the stuff just kind of wobbles around and goes nowhere, just a sideways movement. Then when you get to the front page of the book, all of a sudden the price, the real actual data, it just takes off and starts climbing. And up and to the right, that means real good things. So I watched this for a few days and I thought, wow, this really looks great. And I'll explain why I thought it looked great later on in another lesson here when we get into the finer points of technical analysis. But I bought into it. And in the book, I use the information for one price share. And that's kind of lame, doesn't get anybody much excited. But in the course of events, using the methodology that is in there, recommended, this went from where I bought 84% up in approximately, it was less than 3 months. When I saw an 84% return on investment, I'm going, yeah. 84%, if you would have done that in an annual transaction with nothing else being done, is not very exciting. It's I think it calculates out to about 14%, 15% or something, which it'll kind of be better than, you know, an interest on a bank savings account. But for an investment purpose, that's into the realm of acceptable. There are financial gurus, I'll call them. They know exactly that they're using stuff that I'm not even aware of, formulas, charts, whatever. And they're looking at 250%, 700% in 1 year. And I'm going, ooh, that's kind of getting into the realm of the pros. Well, I'm not the smartest person in the school, so I'm just happy to make a nice return. And I gave an example in one of the earlier lessons about junior high kid that got into finance, went through a bachelor's degree in finance, and was a millionaire, net worth over $1 million by the time he graduated. It was about 10 years. That is very doable. And the only reason it took him so long to get there was he was drawing a salary, living off of his earnings. In the end of the book that I wrote, I did a little what if scenario, because I did the front stuff, and it's real. I mean, right there, you know. When I get to the end, though, I don't have a whole bunch of data that I can say, this is real. So I had to, should we say, use Monopoly money in a spreadsheet. In that example, I went from 84% return on investment to 50% return on investment, a considerable less number. And still, even at that number, it came out to 4.5 years of investing with a return of net of over $1 million per year forever. So, and that's with one-time upfront investment. It's not one of these things where it's like a mutual fund. You have to keep chunking along every month, putting a little bit in, a little bit in, a little bit in, a little bit in for a long, long time. If you want to go that route, you will end up very nice at the end. I don't have the patience for that. I'll just tell everybody straight up. The last big bundle that I'm going to bring up, I did my homework earlier in the week. Then yesterday I made up a thumb drive of all the stuff I want to have here. And I got the website on the browser search engine, and I clicked, and I printed directly to my thumb drive, had it go print it, and then I looked at what I'd printed, and I printed the page, the site after the one I wanted. So this is bogus. So what I want you to be aware of is webull.com. Now I'm going to unpack that name right now. We, the investors, are bullish on the stock market. And what that means is a bull, when it charges, will come in low, hook the horns under whatever, and then raise their head up and throw things into the air. It's an upward movement. For an investor, they want upward movement. That means their stock is becoming more valuable. So webull.com is a, what do you want to call it, aspiration of future success. The other term that you will hear sometimes, if you're watching, I don't know, MSNBC, is the market is bearish today. Well, a bear out in the woods, when it attacks, it will come in high and it will come down on whatever it's after. That's the same thing that happens in the stock market. The bears come in and they pounce, and all of a sudden things are going in a downward motion. So if you hear the word bearish, that's what that means. It means things are going in the tank. So webull.com is a very nice website, because if you go there, they'll have all kinds of little things that you can open up and look at. And they do have some fees for some of their oddball stuff, futures and selling short, things like that. But for the just plain vanilla stuff that is done with a computer, your computer, speaking to their computer, it just flies. No intervention. And their fees are 100% Sipo Nada, which is really, really nice for a beginner. If you have a little investment, $50, you don't want to be paying $7 in, $7 out, because that $14 just totally wipes out any profit that you've made on that $50 investment for a beginner. If you've got zero charge, however, it's like, yeah, I'm off to the races. I'm becoming a pro. So for those that are into their baby steps, shall we say, of learning this, I recommend webull.com. Saying that, I will also say that somewhere along the road, when you're dealing with 100,000, 200,000 investing per transaction, the $7 in, $7 out transaction fee that some brokers charge, or more even, is so insignificant. The percentage to, it's just nothing. Pennies, literally. So, webull.com. Now, I have other information that I'm just going to flash through here, and I don't really want you to get too excited about this just yet, because we're going to unpack this further along as we get this, all how to do the technical analysis stuff, because this is really with your computer, it's the heart of what you're doing. And I mentioned about search engine with Yahoo. You click on the Finance tab. This is the page that will come up. And it's pretty generic. It doesn't tell you very much, but this is the beginning, the home page, shall we say, for the finance section. And you have to wade your way through that in order to get into other things. And the next thing that we're going to be looking at is this page. It has, now I was using GM, General Motors, and I was looking at this little chart here, which is kind of a small little chart, doesn't tell you very much at all, but you have to go through that. So the next major part of this then is to click on that chart, and you will come up with an expanded chart, which is really where we start to get into the good stuff. And I think this is GM still. Yeah, I think. Anyway, after you get past that, then we get into some very technical analysis, fundamental stuff. And my GM example, all of these pages here, there's 3 of them, they all deal with C, I, and F are these pages. These all deal with how to tweak that chart so that you get really what you want, not just a rough thumbnail idea. And we'll explain all of that later on. What we end up with then is a chart that has lines that are superimposed over the price chart information. And if you buy the book, you will see exactly what I'm talking about. Once you get to this place, you have it in the bag. And this is the part here where this comes along and all of a sudden it makes a turn here. The real prices start to climb. And these other lines, they start climbing also. And when you see this turn here at the bottom, you think, oh, okay, nice. Is this going to be a little wiggle that goes nowhere? Or is it going to be this example? So you sit 3-4 days, you watch. Don't do anything, just watch. Somewhere along here, all of a sudden, you will begin to realize that the price chart, what I call the fast line and the slow line, they're all going in the same direction, but there's some serious distance now between them. And you think, all right, it's happening. So at that point, you pull the trigger, you jump in. I don't care if you jump in with $5, $50, $500, you just dump your money into the system. And then you watch. And this is always using historical information and then doing things with that information. So you're always kind of late to the party. Don't get worried about it. Along you come here, and all of a sudden you get into this area. Things start to go up, but then they go sideways. when you start to see the sideways stuff, that's a tip-off that something is happening. We don't know if it's going to go up again. We don't know if it's going to go down. Another 4 days of sideways. We don't know. We don't have a clue. So we just kind of sit here. Sooner or later, though, all three of these lines, the price chart, the fast line, the slow line, they will all come together at the same time, the same point on your chart. At that point, I bail out. And I never am at the top, but from where I got in to where I finally do exit, oh, I've made a fortune. So that is how we play. We don't really play, we work the market as an investor. Later on, you can also do the downside, and that's called selling short. Don't do that. Don't go there at the beginning. The reason I say that is, this is like you know that we're going to have a huge increase in the price on wheat in 6 months because of a famine somewhere in the world, or because of a fire somewhere that took out a whole state's worth of wheat or something. So you rush out and you sell some wheat at such and such a price. And it's a pretty good price. But it's not exactly the top of the market where it's at today. So somebody, somewhere, probably a baking company, they're going to see this and they think, oh, we got a guy selling wheat here at 10% discount. That's going to be good for us. And they'll come in and they'll buy that contract. You're there with your underwear royally hanging out. You have sold short because you have nothing to back that contract up. You know, however, that the price of wheat is going to go seriously low. And so just before your contract comes due, you rush out and you buy a position in the wheat market. And it is really depressed. You sold high, you bought low, and the difference between those two is your profit. But instead of buying low and selling high, like I just showed you on this one example here, either way, the purchase price and the sales price are exactly the same. It's just the order is switched. Well, when you sell short, you are putting your broker at risk because he is covering your order. You're putting yourself royally at risk. And if things work out, everybody is saying, great, we're having a party. We enjoy the good times. If, however, you have screwed up in your thinking and your expectations, then your broker is going to call you up and he's going to be a little bit unhappy because he has covered you for that transaction. I want my money. And at that point, you better have some stuff to take down and sell at a hawk shop or something. Or be ready to unload some apartments, whatever you have, an asset to cover your messed up thinking. I don't recommend anybody start selling short. I don't recommend anybody start by thinking they're going to be a day trader. Those are all legitimate investment methods, but they are for somebody further down the road than where we are right now. We are learning this stuff. We're not pros yet. So that is pretty much this lesson. And now we're going to start unpacking what I have just talked about. Okay, tools available online. This basically, just the phrase online, talks about computers. There was a stock market before the personal computer, and there's stock market after the personal computer. The difference, however, is what you can do for your own research. Back in the bad old days, I call them, person had to go to the library, and it would be anywhere from $500 to $2,000 for a subscription, well, more than that, $2,000, for a subscription to Morningstar, Dow Jones, Barron's Financial Services. They would sell huge books that would be categorized every, I don't know, month or 2 months, whatever. Very thin paper, and they would give all of the price chart information, the highs, the lows, the basic fundamental analysis, and that's all they had was fundamental analysis at that time. And there was not anywhere near the 14,000 plus shares on the market that we have today. When I say that, I'm talking about American, New York, and the NASDAQ. At that time, I'm guessing there was maybe 1,000, 1,500 stocks. That was it. Anything that was not on the market was in the penny stock category. And you could dig around. That was even harder to deal with then. Pretty much the only people that were giving out information on the pink sheet stuff was the companies themselves. There was independent brokerages. They just didn't even begin to cover it. And by the way, speaking of the pink sheet stuff, penny stocks, I recommend Webull as your broker for these transactions because the information is available to you either at Yahoo or at Webull, and you can do your research. There are other free companies that will broker your deals. And one of the, I'm not even going to mention their name because I don't recommend them to you. Their thing is that they don't advertise. So it's word of mouth. You recommend this brokerage to somebody, you will get a no-name stock, 1 share for yourself, and the other person will get 1 share for no-name stock when they sign up, and 2 shares. And these stocks invariably are in the penny stock area. It's a nightmare to try to sell those, try to make money on them, whatever. One lady I know, she was all excited because, oh, I have these stocks and it's such a deal. Turns out they were in Canada and Colorado, both different companies, but it was marijuana stocks, pot, legal in those entities. And so the price was going up. And she thought she was going to set the world on fire. When she went to sell, however, it was like, oh, maybe you might want to think and wait for another month. We had a hiccup in the market today. So no-name stocks, stay away from. Penny stocks, stay away from. et cetera, et cetera, et cetera. Okay, back to our lesson. Before the PC, after the PC. Before the PC, we only had fundamental analysis. After we got the PC, all of a sudden we had America Online. I don't even think AOL is around anymore. I might be wrong on that. Don't quote me. But I do remember that when AOL was out and big, they had little groups that were chatting online, chat rooms. And if you wanted to build an airplane, fine, it talked about it. If you wanted to go run a marathon, they had one for that. And they also had, miracle upon miracles, one for finance. And everybody was talking about, oh, my return on investment, which is a fundamental term. But then people started saying, wait a minute, what about the MACD? And the MACD chart, moving average convergence and divergence chart, was a total nightmare for anybody to look at from before the computer. There is a formula, and it is a bunch of math. I mean, a lot of math. And what you end up with is one single number, which you can put on a chart. And when you start dotting these all out, all of a sudden you begin to see a pattern. And then you tie that in with other things like volume of shares traded that day or whatever. And you can then go into secondary charts. And those formulas, they were well and good. People began to discuss them. And whenever one would come up, everybody would, oh, I don't know about that. I don't know what that is. And they'd go off and do a search, and they would find a book that would tell them. And all of a sudden, the general knowledge level increased. Today, all these charts, when you get to be the point where you're going to investment seminars, they will teach you about those things. Or you can go to look them up, and some guy from the Ukraine will be talking to you, telling you about the finer points of these. Usually, I find that you can learn this stuff on the one particular little topic, maybe 20 minutes, 45 minutes, and you're a pro. You know what it's talking about. So don't think that you can never learn this, because you can. It's not that hard. It's just that unless you are aware of it, you'll never know that it's there. It's like a blind person being told that, oh, the tree is green, the sky is blue. Huh? They don't know. And until they get some sight, they never will know. So, PCs come in the picture, all of a sudden we have information overload. And that leads to analysis paralysis. And I am guilty of being there. I would get so wound up and so convoluted in all this stuff that I would end up spending days trying to figure out whether I was excited or not excited. And then I would take a look again. Okay, I'm ready to go. What's the price chart doing? It's in the toilet. Huh? I don't like this. Forget this. I was going nowhere fast. So, analysis paralysis doesn't cut it. So in this methodology that I thought up, shall we say, I keep it real simple. And we're getting down to kind of, okay, I'm going to give you a story, truth story here, me, how this methodology came about, and then we're going to end this lesson. It's going to be a short lesson here. I was frustrated. I'd spent maybe 3 years trying to figure out how to do finance. Leading indicators, lagging indicators, counter-cyclical? Does it have anything to do with how much ozone is in the air? Is the sun shining brightly or darkly? Nothing made sense to me. And then one day, I was watching TV. This was about 9 o'clock at night on a Saturday night. And the reason I know it was a Saturday night was the next day, Sunday, oh, it was the best Sunday I ever had going to church. But I'm sitting there watching TV, and they had this hour-long program about Lewis and Clark expedition. These gentlemen in their group, Lewis and Clark were military guys. I don't know if the rest of the crew was military or just, people that had hired on for the trip. They started in the upper Midwest, and they went to the West Coast. Somewhere along the way, they picked up this lady who had been rejected by her Indian tribe, Sacagawea. And the Indians, as they went on their trip here, they did not talk to each other verbally, but they had a common sign language. And so Sacagawea was their translator. And she really made this little trip highly successful for them. They went through basically westward to northeastern Oregon, and you can still follow that trail. Might be kind of hard in places because of freeways or towns or whatever, but it's there. It's traceable. You can actually go to some of the campsites and some of the places that they walked that trail, Lewis and Clark Trail. I do know that they eventually ended up northeastern Oregon. They ended up then at the Columbia River. And they either made canoes, I think it was, and they floated all the way down the Columbia River to what is today Astoria, Oregon. And they ran into the Pacific Ocean. And they stayed there long enough to seriously contract a bunch of diseases. And when they started their way back, of course, all the crew was very sick. A bunch of the guys died because of the diseases that they got contaminated with. And Lewis and Clark ended up in, I think it was St. Louis, if I remember right. This trip took years for them to do. I have it in my head around 5 years, plus or minus, I don't know. But the tagline at the end of this program was, "Today you can follow this trail, and it will take you a lot of time. If you get in a commercial jet and you're flying over this same area, 500 miles an hour, plus or minus, you're looking at hours, 5 to 8 hours probably, to go that same distance." At that time, the space shuttle was flying. It said, if you get on the space shuttle, you go over this whole area in a few minutes, 20 minutes or something. And I'm going, wow, that is the secret. So we have the price chart, the fast line, and the slow line. And these levels, if you track the financial data, is exactly what the good old boys were using back before computers, before the 1929 stock market crash. And they're still using it today. It is an inside secret, shall we say, that is not disseminated to the public. And I am not exactly happy about that, because I really feel that we have the haves and then we have the have-nots. And the difference between the haves and have-nots is millions of dollars a year in earnings, shall we say, and tons of grief and divorces and suicides, bankruptcies, whatever, because of the great distance between the two. So I highly encourage people, stop being poor and learn this stuff. This is going to be, I'm just guessing, between 6-9 lessons, something like that. And it's not going to be everything, but it will be enough for a person to be highly, highly, highly profitable. So, for your own benefit, watch these videos. Okay, we're going to continue on with the technical stuff, and we're going to unpack these packages that I bombed you with today. So, thank you very much.